Thank you, Tara. Hi, this is Stacy Roberts. I'm a senior manager in the State and Local Tax Department here at Eide Bailly, and I physically sit in our Denver office, and joining me today is David Casper. He's a colleague of mine in our Fargo office. And as Tara mentioned, our topic today is Washington tax update. And for those of you who may have been following some of our previous presentations, we've started to kind of showcase states. We had a California presentation about a month ago or so, and so stay tuned because we'll be adding more states to our lineup. But so far we're California, and now we're going to touch on some topics for Washington for those of you who may already be doing business in Washington or are potentially contemplating doing business in Washington. So here's our overview of what we're going to discuss today. First of all, doing business in Washington, there are some specific rules around that. They have various rules for different classifications, and we'll talk more about that. And then we're going to discuss opening and closing a business in Washington. So if you are entering the state, or perhaps you're actually exiting the state at some point, what you need to do for that. We're going to talk about Washington income sourcing. They do have some specific rules that taxpayers should be aware of. We're going to talk about the business and occupation tax forms and some tips and tricks on reporting. Also touch on some Washington sales tax issues, some common issues that we see, and some things that perhaps may surprise some taxpayers out there on taxability. And then just end up with some updates and some reminders for the state. So, jumping into doing business in Washington. So, just as a backdrop, this slide talks about a couple of Washington taxes and what we're going to focus on today. There are other taxes that Washington imposes, but where they get the majority of their revenues is from the sales tax and the B&O tax. One thing to keep in mind is that Washington, most people know this, but as a reminder, there is no corporate or personal income tax in Washington, so they are getting the revenues from other types of taxes. The sales and use tax in Washington operates like a lot of the other states, although as you will see later, there are some transactions and some types of businesses that may be surprised at the taxability because not all states may tax those transactions. Another issue with the Washington sales and use tax is that the average rate is 8.9%, which is fairly high. And I say average rate. In some of the cities, such as Seattle, it's going to be higher than the 8.9. And just one note on this 8.9%: if an auditor comes in and looks at work papers and is pulling together work papers, they use this 8.9 as what they term their pool rate. So if you have a situation where you are selling into Washington and you are under audit, it's a really good idea to kind of look at the rates because they are going to just immediately go to this 8.9% and impose it. So just one tip there. And then they do impose a business and occupation tax, which is the B&O. It is not a net income-based tax, and so sometimes this can catch taxpayers off guard. It is a gross receipts tax, so it is on the top line. It's imposed at varying rates depending on the business type, and we'll talk more about what some of those classifications are later. Also keep in mind that Washington has several cities, and those cities also impose their own B&O tax. They don't impose separate sales tax, but they do impose a separate B&O tax. So just keep that in mind if you are doing business in the state and may be doing business in some of the bigger cities. So, what's doing business for purposes of the sales tax? Generally speaking, engaged in business is a defined term, and it can include having a physical location, having employees or independent representatives in the state, leasing any kind of property in the state, having an affiliate, and we'll talk more about what that means, but if you have some kind of an affiliate relationship, whether that's with a related party or a not related party, that can be problematic for purposes of sales tax nexus. Attending a trade show, and you could just be attending a trade show, you could be speaking at a trade show, or at a convention, you could be making sales on the spot at a trade show. And then having inventory, which is basically having inventory at a warehouse that perhaps a taxpayer owns or in a third-party warehouse. So those are just some examples of physical presence for purposes of nexus and for sales tax nexus. So again, on the B&O side, physical presence counts, retail location, inventory, such as having Amazon locations. A lot of people on this call are probably well aware of the state scrutinizing Amazon locations, since Amazon now has more and more warehouses, and that inventory can move from place to place because it's under the control of Amazon. And then having in-state employees or representatives can be problematic for B&O. Also, the state imposes click-through nexus, which is basically a concept that comprises relationships. So click-through nexus can apply when you have an online seller that's advertising their product on another company's website. And for Washington purposes, revenues generated from clicks on the links of in-state affiliates, which lead to remote sellers' websites, they must exceed $10,000 in order for nexus to be created. Furthermore, for the business and occupation tax, they have imposed economic nexus standards. And some of you may be well aware of the states, particularly on the income tax side, that have factor-based presence, or what we call factor-based presence, meaning if they exceed some certain thresholds for revenues, payroll, or property. Well, Washington has also instituted those rules. Interestingly enough, for the retailing classification, the legislation went into effect July 1st of last year, where if revenues are greater than $267,000, and those would have to be Washington sourced receipts, then a taxpayer would have nexus. They don't have to step foot into the state, they just have to exceed these thresholds in order to have nexus. And then also they have the catch-all that if at least 25% of your revenue is Washington sourced, then, or if it's 25% of your annual revenue exceeds that dollar threshold, then you would have nexus for the retailing classification as well. On the apportionable income and wholesale sales side, and apportionable income is typically for service-based businesses and royalties. Those nexus standards are slightly different, but somewhat the same, as you can see here on this slide. $267,000 of Washington receipts, and these numbers are as of 2017, by the way. Payroll exceeding $53,000 and property exceeding $53,000, and then the 25% catch-all. Keep in mind that for apportionable income activities, this economic nexus standard has actually been in effect since 2010, and this following slide shows those thresholds that they have and how those have been adjusted over time. Technically speaking, I think that the state is saying that these are being adjusted for inflation. However, they do apply some kind of factors to these to come up with these dollar thresholds. Note here that on this slide here at the bottom, for the 2018 numbers have been adjusted slightly. And also note that the state does pay attention to these. So it's really good practice for taxpayers to, if you haven't exceeded the thresholds yet, keep track of it, because perhaps you may, and the state will keep track of that too. Okay, and so that brings us to our first polling question. True or false, Washington's average sales tax rate is among the highest in the nation?
And just a quick reminder for those of you that may have joined us late, these are the polling questions that we need you to participate in if you plan to receive CPE credit from today's session.
Okay, it is true. So with that, I'm going to go ahead and turn it over to David, who's going to walk us through opening a business in Washington.
Good afternoon, everyone. We've decided that we want to open a business in Washington. It's a grand idea, but what sort of things do we need to take care of? One of the first things you will need is a registered agent. Your attorney may provide that service for you. There are also registered agent companies that are out there. The next step, register with the Secretary of State. The fees usually aren't terrible, $30 to a couple $100 in most states. And then you complete the business application with the Department of Revenue, and at which time you will obtain a unified business identifier number. You will be registered with the Department of Labor and Industries, basically workman's comp, the Employment Security Department, their version of unemployment insurance, very similar to what you did at home. And you may have business applications at your city levels as well. Then we can come on, and this is sort of another little short breakdown of it, how you would register with the Secretary of State. Do you need to talk to Corporations Division? And a big question we get is, do you need a sales tax permit in Washington? This permit can be used to purchase merchandise and inventory for resale to others, provided you don't intend to use it for yourself. Examples of this would be merchandise in a store, items that become components of a manufactured item, also materials for construction, some labor. You cannot use this to purchase items for your own use, to give away, or for speculative building. So very similar to a lot of other states. If you're intending to purchase things and use them in manufacturing or sell them to someone else, you will need a reseller's permit. As perhaps things have progressed along and we've decided that we've been in Washington for a while and now it's time to leave. There are some things that you should look at very closely if you decide to leave Washington. To close out your business, you are looking to request a revenue clearance certificate from the Washington Department of Revenue. This is a certificate the Department of Revenue is signing off that your debts or issues are all taken care of. You will not be able to dissolve your corporation with the Secretary of State until you have this document. So we've gotten our clearance certificate. We notify the Secretary of State. We notify our registered agent. We take care of all our final returns, whether it be workman's comp, unemployment, sales tax, withholding. We've alerted all the different departments that we work with at the state. So this is a common mistake companies will make. They will be in business, they will close up shop and leave the state and forget to tell these agencies that they've left. And 6 to 9 months later, the mail starts coming in from the state looking for filed returns. And it's a little bit difficult to clean up after the fact. And always hang on to your records for 5 years or better. One thing you can do before you begin this closing down process is you can request a different sort of letter. It's called a tax status letter. It is a snapshot in time of your business as far as the Department of Revenue is concerned. You can either request this letter online through their website or by filing this paper form. This letter provides details regarding, what have you got for outstanding liabilities, credits, any specific issues. It's not a verification that you're cleaned up with the state like a revenue clearance certificate is. This is the status of where you're at today and what you may or need to take care of before you can get to the stage of having a revenue clearance certificate. Also, this may be something good to do if you're considering purchasing a business in Washington. Get an idea of what possible liabilities they have. On this tax status letter, it's a snapshot in time. It's based on the date you sent it in. It's not everything, but it's a really, really good starting point, and there's no charge for these.
So before you or a taxpayer may want to get a clearance certificate, one of the issues that taxpayers should be aware of is the fact that Washington is a state that has what we call trailing nexus, and it's statutory. So what that means is that if you stop doing business, or seemingly think you stopped doing business in the state in a year, they still will require returns for the following year. And it could be such a thing that you've fallen under the thresholds that we talked about earlier. So let's say, for example, you've fallen under the threshold of $267,000 and you don't think you have Nexus anymore, and so you plan on exiting the state. Well, you would still have to file returns and potentially pay some tax because of the fact that you may still have sales into the state. And then in year two, same situation. You'd still have that trailing nexus, so therefore you'd still have to file returns and potentially pay tax. Well, what can also happen is that then you may think that you're done, but you then have to look and see in year three, did my sales spike again? So it's a little bit of a gotcha. And like I said, this is statutory, so it's really important for taxpayers to take a look at this and not just think that, okay, well, I've exited the state, I don't have physical presence anymore, my sales have trickled down. They're going to expect returns. And so don't just expect that you're going to be able to flip the switch and leave the state the minute that those activities have ceased. And again, the Nexus standards are, such as I mentioned earlier, with respect to the dollar thresholds for apportionable activities or retailing and wholesaling, and then just the physical presence Nexus standard for some of the other classifications. So, with that, then how do we figure out whether we actually do exceed these thresholds in these states, or in this state? So I'm going to talk a little bit now about how does Washington actually then source the income to determine whether you've exceeded that $267,000 threshold. As I mentioned, apportionable activities include service income and royalties. And basically the state says you're sourcing these based upon a receipts factor, which operates and looks very similarly to a sales factor in an income tax state for apportionment purposes. So you would use your everywhere number as your denominator, and then your numerator would include potentially sales into Washington if the benefit of the service is received in Washington. And these rules here that I have listed out 1 through 7 are basically the state's cascading rule on how you determine if that sale or sales should be sourced to Washington. First and foremost, they say that the sales should be sourced to Washington if the benefit of the service is received there. And the first prong would say, if you can reasonably estimate that that service, the benefit of the service was received in Washington, then we'll use that reasonable estimation and we'll accept that. If you cannot determine that reasonable estimation, then the second prong would apply, and you would attribute the sale to the state in which the benefit of the service was primarily received. If you cannot figure out one or two, then the service is sourced, or it's attributable to the state from which the customer ordered the service. If you're not aware of that, then you turn to prong 4. It could be attributable to the state to which the billing statements or invoices are sent to the customer by the taxpayer. So customer billing address, basically. If you can't figure that out, if you don't know that, then it would be attributable to the state from which the customer sends payment to the taxpayer. If you can't figure that out, you don't know that, that's not information that you know, then it's attributable to the state where the customer is located, as indicated by customer address, which could be different from the billing address. If none of the above can be determined, then it goes to commercial domicile of the taxpayer, which in some cases may not be Washington. So therefore, these rules, depending upon what type of service is being sold, you might have to look through this and see whether you would meet any of these prongs based upon the information that you have, and then determine whether a piece of it then should be sourced to Washington. So with that being said, and going through these rules, you may have a situation where you don't have 100% of whatever sale you think is destined for Washington, where that benefit is totally received in Washington, and therefore you may have a situation where you source some of it outside. And some of that can occur, for example, if you were selling a service, say, to a billing address or, a customer in Washington, right? So, a Microsoft, for example, and they have offices in other locations, but so perhaps the offices in the other locations are actually getting some of the benefit of that service too. So in that case, I would argue you're not necessarily having to source 100% of that sale to Washington, because the other offices around the country could be receiving some of that benefit too. And 100% of that would not necessarily go to Washington. So that's how you can apply these rules to that type of income. And then on the sale of goods, which seemingly should be fairly straightforward, it makes sense that if you have property that is being sold to a Washington customer and it's destined for Washington, then that could be subject to the B&O. Also, that if it's delivered outside of, so let's say a sale originated in Washington and it's delivered outside of Washington, then that would not be subject to B&O. And where this can get a little complicated is if you have, if you're using a shipping company, because where I've seen this occur is, let's say, for example, you have a taxpayer who has a shop or a location outside of Washington, say, for example, Oregon, a neighboring state. And customers actually will arrange shipping at the location in Oregon. So basically, they're taking title to the goods in Oregon. But let's say the customer, the billing address for the customer, is in Washington. Well, Washington doesn't know that that sale is not necessarily going to come to Washington. So upon audit, they're going to say, show me some documentation that says that didn't enter Washington, because they don't know any different. And so when you have these situations where items have a billing or customer address of Washington, or they perhaps may be going through Washington, a good example would be, let's say it's something that's being shipped into Washington and it's moving on to Alaska. So, there's a lot of ports in Washington. So something could be shipped on to Alaska. It's really, really, really important to provide that documentation to show that it's not staying in Washington, it's not destined for Washington, because otherwise the state doesn't know, and upon audit, they're going to look for this kind of documentation, and you're going to have to prove, or the taxpayers are going to have to prove, that it did not stay in Washington. So this has come up in several audits, so it's just something to keep in mind. Keep your invoices, keep your trip sheets, keep your bills of lading. Make sure they're pretty detailed, that shipping companies know that it's not entering Washington, and that That way you can provide that documentation to auditors to show that those are not Washington sales. Okay, and with that, I'm going to turn it back to David, and he's going to talk a little bit more about the actual reporting.
Oh, yes, this is, now before I turn the screen to the B&O return, if you're a little bit intimidated by it, don't worry about it. Everybody is the first time they see it. But the first thing to discuss is what are B&O classifications? So this B&O is the tax on your, basically your gross receipts into the state. Is everybody taxed at the same rate? No, they're not. And it's actually kind of interesting to look at these categories, because you may have sales falling into the retailing category. You may also, as a company, have wholesaling sales. Notice there are two different rates. Manufacturing and wholesaling and extracting, B&O, they're at the same rate. But you could be a company who does some wholesale sales into the state and some retail sales. Travel agents get a break down to a lower rate, and so do service providers. We have these different rates for these different, think of them as activities. Now we come to the form, which you can't see on your screen. I'm going to split it into a couple pieces and we'll take a look at it. There are different variations of the B&O form depending upon certain people specifics. We chose this one as being the most typical form. So let's move on to the top. We'll first look at the top half of the form. So this form, you report both your B&O and your sales tax for the period. So we start off on the top of the form and we're doing our B&O tax. One thing to note is in column 1, gross amount, under that heading that says state business and occupation tax. A lot of people get this one off. That number is your worldwide income from whatever category it happens to be. If you were strictly a travel agent falling in line number 3, you would put in line number 3 all of your receipts as a travel agent. There's pages 3 and 4 of this form that we're not going to go through, where you can total up deductions from this gross amount. And among those deductions will be activities that are not sourced to Washington. Well, even though you're putting in your worldwide or countrywide gross amount there, you are not paying tax on it. You are allowed to take a deduction for your income sourced to other states. What's also interesting here is if we've got 17 possible categories. Manufacturing, wholesaling, number 1, extracting for hire, picture maybe a logging company or an oil field operator. There is also, I find particularly interesting, line number 12. The cleanup of radioactive waste for the US government has its own specific category and tax rate. Just found that to be quite interesting that they would have their own category for that. So we've broken out our revenues in total into the categories, dropped them in column 1. On the sheets 3 and 4 of this return that we won't go into, we figured out what our deductions are. We've got a net amount. We multiply by the posted rate in column 4. They end up in column 5. And we subtotal them down at the bottom. That's kind of the highlight for the top half of the return. One thing to keep in mind is there are other cities that have their own B&O returns. They may be similar to this, but they may have some very unique calculations. We'll move on to the bottom half of the page. Our bottom half of the page, We've got that state sales and use tax, black there. Row 18, we put in our retail sales. Row 19, we would put in our use taxable purchases, those things that were untaxed and we removed them from inventory, or perhaps they were Amazon purchases, online purchases, things where we didn't pay tax on them and we owe tax to the state of Washington. We would put those in that box there on row 19. Then our next couple of columns that aren't available in 19 but are available in 18 would be any exempt retail sales. Subtract those from the total retail sales, and we end up with our retail sales amount subject to their 6.5% tax. But we can't forget that we have special county, city use taxes and sales taxes in Washington, just like in other states, and those would go into that local or city sales and use tax box on the left, rows 20 through 23. If you are a Starbucks on a corner and you never move, you likely only have one location code that you will ever use. However, if you are a route salesman, an ice cream truck driver who drives around the city, you may have dozens of locations. I looked at one of these the other day where the client had like 50 different cities they were selling in. You have to enter it all in. The bright side to their situation is that the online version of the form, you can just keep adding in the cities. And then over on the right, you total it all up. It's actually not that bad a return once you break out the top half from the bottom half. Do their schedules that are on pages, I believe, 3 and 4, where you're showing, these are my big sales, these are my deductions, this is how I'm getting to the numbers I'm going to enter on the first page. And then after that, we come to polling question number 2. The B&O rate for the wholesaling classification and the retailing classification are the same. True or false? And how did we do? 98% correct. Perfect. They are not the same. There are some credits that you may find on this that you can use on this combined return. They're out there, high-tech credits, training credits, alternative fuel vehicles. They're out there. Before taking one of them, I would really scrub the instructions and do a little research to make sure that they apply. And keep in mind, Washington has 280 cities. A lot of them will have a local tax that you would need to report on the sales tax portion of your B&O return with all the different location codes. Also, 40 of these cities impose a B&O tax of their own. Stacy, if I understand this correctly, a business that's working between cities could not only have to file one state B&O return, they could file potentially 10 or 40 B&O returns.
That's correct. And if anybody's familiar with Colorado, not that this is a similar scheme, but you know, I sit in Denver, and some people on this call may be familiar with the fact that Colorado has home rule cities, and in some ways, the 40 cities in Washington that impose their own B&O operate a little bit similarly in that you need to get registered in those jurisdictions and then pay the B&O. But as we've said, it's B&O and not sales and use tax, because that sales and use tax is captured on the state form for those locals.
Oh, believe it or not, we get another polling question quite so quickly. But I think it should be having a really high pass rate. Some Washington cities impose their own B&O taxes. True or false?
You know, I just want to, while we're waiting for the poll results, I just want to mention one thing about the B&O that it is, and I guess we didn't say this at the outset, but it is an entity level tax, meaning it's an entity by entity tax, so it operates, you know, similarly to a sales tax that way. So there's no opportunity to do a consolidated election or combined election such that there is in Ohio, for those of you that are familiar with the Ohio Commercial Activities Tax. Having said that, though, too, think about this. You may have a situation where you have intercompany sales, and so you don't get the opportunity to eliminate those, and those can be, you know, subject to tax. And so I think in some ways Washington thinks that they have a fair system because, say, for example, you have a situation where an affiliate will sell something to a related party at wholesale, and then that related party will sell it at retail, and you've got different rates, but it's not a VAT system. So there's not input tax credits like a VAT system. So that's in some ways why some people feel that this tax is pretty unfair. So I can go over the results. So they're up on the screen. So true, high pass rate, David, like you said. So we can move on.
We appear to be stuck.
Okay, I was just going to ask that. Give me just a second. Did that jog it?
Yep.
Okay.
Okay, I think we're back. All right, so I'm going to talk through a few sales tax items just for taxpayers to be aware of. You may already be aware of some of these, but just a few reminders. Documenting untaxed sales with resale certificates. Seller must provide documentation, and this is not unlike any other state, to prove that a sale is a sale for resale and not retail. We mentioned this earlier, but make sure that documentation is kept for 5 years, and then you have up to 120 days from the date of the sale to collect the documentation. Documentation options include a paper or electronic copy of a reseller permit, a printout of the customer's information on the business records database, and then you can also get confirmation codes through the reseller permit verification service. Reseller certificates, some things to maybe note on these, unique to each business, again, not very different from other states. However, the last 2 digits of the number actually are related to the year it expires. So that is something to keep in mind. And then the effective dates of those permits are in the upper right-hand corner. So just to keep these tidbits in mind when you're looking at these certificates and making sure that you have updated and or looking at certificates that may be close to expiring. Here is, and this is very hard to see on the screen, but here is an exemption certificate. We're going to, similar to what we did with the B&O return, we're going to kind of break this down and highlight a few areas on this. This is a Washington-specific exemption form. And what's interesting about this form is that if you'll see the highlighted areas on the screen here on number 5, there are some grayed out areas, so state and local government, permit numbers, charitable organizations, religious or educational organizations. Note that even though these are listed on this form, that those type of permit numbers are not available in the state. You might be able to get those type of permit numbers or exemption numbers in other states. However, they don't apply for Washington, and we'll talk a little bit more about some of that in a moment. There is a way to verify resellers permits. This is a really nice, I think, function in Washington. There's a lot of other states where if you want to verify that your customer is registered with the state, you would actually need a number. So it kind of defeats the purpose at that point. However, with Washington, you can actually go into this website here and type in their name to see if they're registered, which helps. So for example, if you were being audited or you were doing an internal review and you were wondering if perhaps you should have charged tax to a customer, perhaps that customer is already registered in Washington and they've self-assessed use tax. So this is a good way to verify the fact that those potential customers are registered. And as a side note, the Department of Revenue will look up taxpayers. So for example, if you were under audit, there were some situations where perhaps you didn't charge tax, then the auditors will go through and verify some of this as well through the process of the audit. One item with Washington that might surprise taxpayers is that purchases by Washington, the local, state and local governments, are typically taxable. That's not always the case. Federal government sales are exempt. However, state and local government sales are typically taxable. So keep that in mind. We've had clients, taxpayers, be surprised by this. And that goes back to the fact, if you recall from showing the exemption certificate, that there is no ability to have a state and local government exemption number on that form. So we have had, like I said, clients surprised by this, and unfortunately, their purchases were taxable. For nonprofits, nonprofit organizations that are conducting qualifying fundraising activities, they're exempt from the B&O and sales tax. Those fundraising activities would have to be limited to directly soliciting for property or selling goods or services to further the nonprofit's goals. So this gets a little dicey when we've got nonprofits that have a regular place of business and they're selling items through that business. So the examples here are through a bookstore, thrift shop, restaurant, similar, food truck, you name it. Once you start having a regular place of business that is selling items, then that can taint the taxability or the exemption status of it. So just keep that in mind. And then also the nonprofit definition of like what is a nonprofit for purposes of Washington is pretty narrow, and that it's a 501c3, 4, or 10. So there are other potential charitable organizations and nonprofits that are out there, and they are under other codes or under other sections of the IRC. However, they would not qualify. So again, a narrow exemption here. Furthermore, Washington taxes a lot of digital goods or computer-related products. So downloads of books, music, movies, pre-written software regardless of delivery method. So we've got situations where anything that's electronically downloaded, that's going to be taxable. Your software as a service, those kind of transactions, those are typically taxable. In similar vein, it's charges for anything that's in the cloud, so similar vein to a SaaS. Those are taxable. So they have some very narrow exemptions when it comes to computer-related services. However, they, like I said, they're very narrow. So depending upon what your business is, it could be that it's likely taxable. And like I said, there are just a few exemptions where it might not be in this space. Okay, and that brings us to another polling question. True or false, you can validate a customer's exemption certificate on the Washington Department of Revenue website. And wow, 100% true, 100% correct. So with that,
Perfect.
I'm going to turn it over to David.
Okay. The next short section here, it's probably going to sound a little doom and gloom and fire and brimstone, but please, we've got some pretty good reasons for it. So let's picture this next bit is how it's going to apply to a smaller company. Okay, I have a couple of guys I know that build custom trailer hitches. It's two very talented guys in a welding shop. They've got a little website they sell these custom hitches on. They sell them at a few trade shows, but they're very conservative about where they're going. They don't create NEXUS anywhere. But we've got my two friends making their hitches. And then Washington, beginning January of this year, say that remote sellers, for example, my two guys making hitches, making $10,000 or more in retail sales to Washington, have two choices. Sign up for and collect Washington tax on their sales to the Washington purchasers, or comply with these use tax notice and reporting requirements. If you do not affirmatively notify the Department of Revenue by signing up and getting a tax permit, it is presumed that you elect to comply with the use tax notice and reporting requirements. Okay. This is, picture my two guys in North Dakota making hitches, selling them online. How would they ever find out about this? What are these? And they don't have the technology to collect and remit sales and use tax on sales into Washington. The notice requirement. You have to provide a notice to the customer. It can be on your website and your catalog or order materials. I just checked one of my favorite online vendors and their Washington notice was buried in their FAQ section. You need to provide notice to each customer at the time of sale. And you need to provide an annual report to the consumers. So if one person bought a bunch of things from you, or even one thing, they get a letter from you or notice at the end of the year saying, these were your purchases that you probably owe tax on. Then that same information also has to go to the Washington Department of Revenue. The thought being that the Washington Department of Revenue is likely going to send out bills to these taxpayers wanting the sales tax. Okay, can kind of get behind that if they're going to get their tax and they're asking nicely for the remote sellers to do this. This not only applies to remote sellers, it also applies to what they call facilitators, your Etsy and your eBay as well. But these are the penalties. If you did not post that required notice, it's $20,000. If you did not provide the DOR with a list of customers, it's $20,000. And then there are bunches, further details of basically fines stacking up. There is a situation where my two acquaintances who build these hitches, maybe they had a really good year. Maybe they sold 15,000 into Washington. How are they? They don't know. Washington didn't send out notices to every retailer across the countryside about this. It is possible that, according to the way the rules are at this point, a Washington auditor could show up, audit them, find they did not meet the requirements, and hit these guys with penalties 3 times the retail value of what they sold. Our prediction is somebody is going to challenge the scheme of the fines. At least for me, I don't feel that the punishment fits any perceived wrongdoing at this point. If you are making online sales, which also would include phone sales, or any sort of remote selling into Washington, please, please, please look at your sales volume. If you are over that 10,000, there are some steps that you should take. There are further details available on the Washington Department of Revenue's website. It goes into quite a bit more detail than I wanted to put here. If you need assistance, talk to somebody. This is not going away. This is very similar to a scheme that is imposed in Colorado at this point, and that has been through several of the courts, and it has been found to be, I guess, valid. They can do this because they are not imposing a tax on you, they are imposing a reporting requirement. I believe the minimum threshold in Colorado is $100,000 worth of sales. The fines are still stiff. They are not as stiff as Washington's. Colorado is more detailed about what you have to provide for notices and the like. This is also, has been imposed, similar schemes in others, I believe 5 or 6 other states, but these are the only 2 that have any teeth to them. But if you are making remote sales, that be by phone, fax, if anybody does that anymore, or by online into Washington, check and see what your retail amounts are. If you're over that 10,000 in Washington, 100,000 in Colorado, you may have some notice and reporting requirements to get on top of. And for our final polling question, sales to state agencies in Washington are not subject to tax. True or false?
Looks like everybody, or majority of people said false. Good. All right.
Stacy?
Yep. Okay. Looks like we're still stuck on the poll, maybe, for a moment. Okay, just a couple of reminders in our last few moments. And you know, like David said, we're not trying to scare anybody with the notice and reporting requirements. However, they did go into effect January 1st, and it's really, really important for taxpayers to abide by them. You know, just a note about Washington. They are a fairly aggressive state, and they're fairly well staffed, meaning audit staff. So, and you know, they have a pretty robust audit staff. So it remains to be seen, you know, from an administration standpoint, how the notice and reporting is going to go. I mean, I'm in Colorado, and we're still also kind of grappling with that from our standpoint. So these are new for most of the states, and we'll just have to kind of wait and see what happens. However, it really is important for everybody to understand that those penalties are steep, and so we don't expect the states to just walk away from those. One note for Washington, and honestly, this could apply to a lot of other states. Washington, just be careful, and like I said, this could apply to other states as well. I mean, they have a system in place where, and most states do too, that there may be a determination that's made, and then if the state doesn't really like that determination, they can always go back and change the law retroactively, and then we're stuck with that retroactive law. So just keep that in mind. This is kind of walking through a timeline for a specific fact pattern, and like I said, it's not just unique to Washington, but a specific case that happened there. One thing to also keep in mind, and most states have these programs, but the Washington Voluntary Disclosure Program, if you think that you have if you're a taxpayer, if you have a client that may have some exposure in Washington, the Voluntary Disclosure Program is a really good way to go. I will tell you that if you're discovered by the state of Washington, they will go back, they will audit, and they will go back 7 years, and the 39% penalty is statutory. So it's a big number, and it's almost impossible to get abated. And so the Voluntary Disclosure Program, what's nice is that you can do it online. Again, it is an online application where you are potentially identifying who you are out of the gate. However, your look-back period is limited to 4 years plus the current, so you're not stuck with 7. You are going to get for most taxpayers, you're going to have the 39% penalties waived, and so then you'd have tax and interest to pay, and then you'd be clean and you'd just go forward. So I really recommend the program. What's interesting too is that when you apply, they have a team that is ready and willing to get you going into the program. I've had clients that have applied online and gotten their package back from the state within hours. So make sure that you're ready for that. So if this is something that you're interested in pursuing, make sure you have all your documentation ready, because the state's going to be ready to move on it. But they're very good to work with if you're proactive. So with that, I know that we're out of time. We're at the top of the hour, but I'll go ahead and I'll pass it back to Tara, and I appreciate everybody's time. We'll see if we have any questions or time for questions. But David and I definitely appreciate everybody's time, and feel free to contact us, anybody in our SALT group, if you have questions.